You need to watch this video because it could change your life. Seriously, these are 10 of my favorite stocks. These are tech stocks. Now, if you don't understand my background or the channel, I worked in software as a service for about a decade, and I quit my 150K base plus commission job to do this and try to help you be a better investor. Now, because of my background, I like to invest in software companies as well as things like semiconductors that are related to things like data center and cloud. So I am heavy in that cloud space, and some of those stocks are expensive and they're hard to understand. I've been investing for over 20 years. I've been a growth investor for 20 years, and I've learned things the hard way, and I'm trying to teach you. I've identified 10 stocks here that I own in my portfolio that I think are buys here and lower. Now I'm gonna do this in rapid fire session. So I'm gonna cover 10 stock picks as quick as I can, but do me a favor and watch this video in its entirety from start to finish. Drop me a like and drop me a comment. Let's get this channel over 30,000 subscribers. I think the channel deserves 30,000 subscribers. Hopefully you do as well. So 10 stock picks, rapid fire. Let's get started. Okay, these are not in any particular order, but the first one I want to cover is Tesla. And of course, this is a bear bull case. A lot of people love it. A lot of people hate it. Stock right now is below $185. I thought the earnings were pretty solid. There's a lot of drama right now with Musk and Twitter and just, all of it. You know the background. Here's the thing, guys. They're doing good things. Not only the cars, you got Model S, Model 3, Model X. We're going to do the semi-delivery event here soon. We've got solar energy. To me, it's a clean energy conglomerate. So you're getting a little bit of that solar in there. You're getting all kinds of great segments that cover these secular tailwinds when you think of clean energy and green energy. And of course, there's politics behind this too. Depending on election results, it could impact certain stocks. But if I look at the last earnings, so $1.05 in adjusted EPS. So that's ahead of expectations, 99 cents. Revenues, $21.45 billion. Lighter than expected, but not by much, $21.96 billion. The free cash flow is absolutely enormous. And some of the comments in here, if you look at Musk here, he says, I can't emphasize enough. We have excellent demand for Q4. We're going to sell every car we make. We're making cars as fast as we can and so on. We're having issues with China, of course. Tesla's likely to do a meaningful buyback next year between $5 and $10 billion, pending board approval, and it'll probably get approved. He also said this, quote, I'm of the opinion that we can far exceed Apple's current market cap. I see potential path for Tesla to be worth more than Apple and Saudi Aramco combined. That doesn't mean it will happen or it will be easy. So no guarantees there. Musk is very confident. I'm confident in this company. I'm confident in the secular tailwind of EVs. And so when you look at what I'm covering here in technology, I'm trying to cover secular growth trends. This gives me that clean energy conglomerate. First pick, Tesla, TSLA. The second pick, another favorite of mine, Nvida. Now, this has always been 150 or less buy. It got lower than maybe you'd expect. Some people think it's too expensive. It needs to go lower. Both Tesla and Nvidia are trading the 60 PE ratio, etc. Now, these earnings weren't great. What people are missing though is that they've already given us this data. We already knew the data and it meet expectations for the guide they already gave us. So they came out and pre-released and we already knew this information. So EPS was light by 11 cents. Revenue was actually a little bit higher at 5.93 billion versus 5.77 billion. The stock's holding up around 160 bucks. It was just below like $110 not too long ago, so it's ran pretty hard. These guys are also doing a lot of different buybacks. One of the main drivers I like it, gaming is obviously down, but data center, you think of cloud, data center chips. So we're going to cover a couple different companies on this video that cover chips for data center. I think cloud is still in early to mid innings. I know people like Jim Cramer say it's in late innings. I don't believe that at all, and I don't think that's fact. And Jim didn't work in software and I did, and maybe Jim's right, but trust me on this one, guys. I'm telling you, there's a lot of room to run in cloud. And not even when you get to multi-cloud, there's so many different components that can be baked out. So not just people going from on-prem to cloud. It's not a matter of if they do, it's when, but there's so many other things that can be stacked on top of that in those environments. Bright spot for NVIDIA's data center business, 3.83 billion in sales. That was up 31% year over year. Other than that, the quarter wasn't great, but it was basically expected. We already knew the information. So when you think of NVIDIA, you think of secular tailwinds. You've got, gaming is one, but really data center. You think of automotive, that was up over 80%. It's still a small segment of their business. I think there's a lot of room when you think of semiconductors and semiconductor equipment within the EV space and just automotive in general. There's a lot of secular growth trends. You think of AI, you think of digital twins, lots of great things going for NVIDIA, metaverse, and this one is number 2 on the list. So cybersecurity is not going anywhere. And you think of endpoint security, there's different segments of cybersecurity. The leader by far is CrowdStrike, and that is the third pick on the list. They have leadership. When you think of Forrester, Gartner, they're validated. You look at this, they're ranked #1 worldwide. Leadership in the Magic Quadrant that we talk about a lot on the channel. Dominates in EDR while building its future in XDR and Zero Trust. You hear that Zero Trust quite a bit. The thing about it, look at this, scale. Ending ARR, annual recurring revenue, $2.14 billion, 64% growth. Profitability, $301 million. Cash flow, 30%. They're not burning cash. They don't need to borrow cash, okay? There's a lot of these SaaS companies that are really expensive, but they're burning cash. This company is expensive. All the stocks on this list are expensive. A lot of times, companies are expensive for a reason. They have premiums because people believe in the long-term objectives of the business, the long-term goals of the business, and that they're gonna make money if they own the stock long-term. So these are long-term investments, 5+ years. They're definitely not cheap stocks. If you're a value investor and you're on here, we are not talking about buying it now and making money next month. We're talking about holding this for 5 and 10 years for these 10 stocks. And we know that not every stock is going to be right, but we do our best to identify them. CrowdStrike, ticker CRWD. Let's continue that trend with Amazon Web Services. Now, of course, you have to own Amazon. The main reason I own it is for Amazon Web Services. With that said, they're doing a lot of exciting things. When you think of robo-taxis for their future, you think of Alexa devices. The e-commerce business, though, it's a tough business. It's low margin. There's lots of complications to global supply chain. If AWS was just by itself, some people think it would be close to $1 trillion market cap where the company's traded. So for me, it's like I'm buying AWS. I get the rest of it kind of free, icing on the cake. These guys are the leader, most comprehensive and broadly adopted cloud platform, offering 200 fully featured services from data centers globally, millions of customers, most functionality, largest community of customers. These guys have data centers all over the world. And you think of the stocks on this list, we're going to talk about a couple other ones. This is public cloud. Okay, so people are going to host their data on this public cloud. Look at all the different partners, all the customers that they work with, from Coca-Cola, Netflix. You can go into all these different segments. Automotive, you got BMW, Rivian, Toyota, you've got Agco and agriculture, you've got all these different companies, Maxar Technologies, you've got different energy companies, retail, Petco, Mercado Libre, GE, Volkswagen, iRobot, and these guys also own things like Ring cameras. That they've got their hands in a lot of different pots. So this is really a conglomerate. I look at it as a tech stock, but really it's consumer discretionary because it's considered, basically retail, e-commerce. But really the main reason I own this thing is for Amazon Web Services. Now, this is very, very expensive. It's one of the most expensive stocks on the planet. It's the most expensive stock I own, and it's a top position in my portfolio. I do have a lot of conviction. A lot of it is because of Frank Slootman and Mike Scarpelli. That's the CEO and the CFO respectively, and they've been together for years. They worked at ServiceNow. Before that, they were at a couple other businesses. They've been together. They're like the Batman and Robin when you think of Silicon Valley, and they're actually headquartered now in Bozeman, Montana, of all places. When you think of single, fully managed solution, so taking all that siloed data and putting it together and making it usable for your users, and not just for executives, but the entire company. Now, this is a consumption-based model. It's not software as a service. It's based on consumption. So it can have more peaks and valleys than, say, a software as a service, recurring revenue type business. But this is really cool stuff. And I have an entire playlist on the channel that has hours of content breaking down Snowflake because it is a very complex business. There's a lot going on behind the scenes. I encourage you to check that playlist out, but make sure you watch this video in its entirety first. But modern applications built on Snowflake, putting customers first, and so on. But basically using your data. You think of data is power. A lot of people say data is the new oil. I think semiconductors is the new oil because data needs semiconductors to work. But really they're hand in hand. Semiconductors and data, they are the new oil. The information that you can get, it's very empowering for businesses. It allows you to have an edge on your competition. And companies like Snowflake are going to continue to grow. They've been growing at a rapid clip. They are very expensive. Be very careful. This has earnings after Thanksgiving. I believe it's November 30th, but it's towards the end of November here. So we also have earnings on CrowdStrike, and there's another stock on this list that has earnings. Be careful with earnings. Now, these are stocks to buy now and lower. Now, if this has earnings, you might want to hold off, wait to earnings. If there's a knee-jerk reaction, sometimes you nibble a bit of shares. But most people buying Snowflake, guys, it should be in your spec bucket because it's very expensive and you may not understand it. Now, I've covered this stock a lot on the channel. I think it's actually inexpensive, under a 20 PE ratio for Alphabet Google. But I'm gonna blow your mind and give you a list of a handful of companies that they own that you might not even know about. One of them is a cybersecurity company, a $5.4 billion acquisition price called Mandiant. Okay, so you think of cybersecurity. Cybersecurity is gonna be a hot trend on this video. We already covered CrowdStrike. We're gonna cover a couple more. So you've got Mandiant on there. You've got other ones like Fitbit, which is wearable fitness devices and applications. You've got Looker, that's business intelligence software and data analytics. Might not even know what it is. Well, they own it. Nest, you think of home products, the Nest products, smart home products. They've got Waze, mobile app navigation apps. They've got DoubleClick, ad management and serving solutions. They've got, of course, YouTube. You're on it right now. Acquisition price, $1.65 billion. That was a great investment. At the time, it seemed expensive, but now, back in 2006, but you look at what it's built, what it's grown into, it's been an amazing return on investment. But like with any investing, it takes patience, and it takes a plan, and it takes discipline, and you're seeing that come to fruition. But Alphabet Google is on this list. Now, they also have Google Cloud Platform. It's one of the big three. It's the smallest of the big three. When you think of Amazon, when you got web services, you got Microsoft Azure, and then you got Google Cloud Platform. So this is also one of the public cloud platform providers. Now, these guys do rely heavily on advertising, and during any kind of recessionary period, advertising is one of the first things you cut. You're seeing a lot of tech jobs being cut, advertising being cut. So this stock could see more pressure, but we've already seen some pretty decent prices. And when it got to $80 a share, whatever it is, I look at that. I think it's an opportunity long term. Can it go lower? Of course, every stock can go lower, but this one's attractive. I own A shares. That's GOOGL. You can also buy C shares. That's GOOG. Same thing, just different voting rights. Okay, so let's cover the other one of the big three. This is the second largest when you think of public cloud, and this is gonna be Microsoft for Azure. Of course, Microsoft is another conglomerate, so is Alphabet. Alphabet's literally a holding company. So these big cap tech stocks, they're not gonna be hyper growth and give you 10x returns, but I have high conviction that they're gonna do well longer term, and then I'm gonna make money on it. I'm not gonna necessarily get rich off them, but I'm not gonna lose money. So this is a blend of hyper growth. You think of the Snowflakes and even like the CrowdStrikes, and then you've got more of this mature growth. Microsoft is actually a DGI, DGIF type play because it pays a dividend, so you got a nice balance there. These guys return $9.7 billion to shareholders. It says down 11% year over year, but $9.7 billion, $4.6 billion in share repurchases, and $5.1 billion in dividends. This is the kind of stuff that you want as an investor. Of course, it's got a higher PE ratio, 25 plus, whatever, but it is a very good company. You also have gaming. You think of the Activision acquisition. If that goes through, there's lots of things going on at Microsoft, lots of good reasons to own the stock, especially the dividend. Now, for me, I actually own this stock at a 7% yield on cost, and I'm up, I think, 400 or 500% or whatever it is on Microsoft. So I've owned it for a while. This one has been very good for me, and I'm going to continue to hold it. And I still think it's an opportunity for investors that want some dividends. Again, not hyper growth, more mature growth, gives you a nice dividend. Intelligent cloud. Okay, you can see this revenue increase 22%. Talks about Azure and their other cloud services as well, 35%. PC is down everywhere. So we talked about NVIDIA earlier. That's, it's down 50% on gaming. PC's down. It makes sense. There's whole through the pandemic, a lot of businesses and individuals, they were at home. They had to buy new computers. It's cyclical. People buy new computers. They buy more gaming rigs, whatever. They use it for a couple years. It comes obsolete. They buy it again. So you buy in the down cycle. If you're following Peter Lynch, you can use cycles and you can make money and that kind of stuff. But that's a whole nother rabbit hole for a different time. But Microsoft is the next pick on the list, ticker MSFT. Now, this one we've covered extensively. We have, exclusive videos on Patreon. You can check out patreon.com/firedupwealth. Actually interviewed an employee for Datadog and talked through all the different reasons, why the company is growing and why it should be on our radar. These guys are doing great things. Unified platform. If you want to know more about it and you don't understand the business, I've got videos for free on YouTube. I've got deeper dives on Patreon. Check it out. I need to announce two guys before I go on. This video is sponsored by The Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. Reminder, they don't tell me what to make. They don't tell me what videos to make or what stocks to cover. They're a great partner, and check those guys out, as well as the Patreon, which is patreon.com/firedupwealth. So check both those links out after this video. But you look at Datadog, they're continuing to grow. What's exciting about it is they're getting more into cybersecurity, cyber. So there's lots of different areas they can grow. They started as a real-time unified data platform, then infrastructure monitoring. You can see it's grown application performance monitoring in 2017, log management, digital experience monitoring, cloud security platform, and you can see developer experience. They're continuing to grow, and their growth, in my opinion, there's a lot of room to grow, not only with the net-based retention of their existing customers, but also new products outside of it. I'm long on Datadog. I've been long on this thing since IPO, and I continue to add. It has, a lot of these stocks have run pretty hard from earlier lows, so you have to be careful with those. But I like this one long, guys, Datadog, DDOG. This is another one we've covered in extensive detail on the channel, and unfortunately these kind of videos don't get views, but they should. But Zscaler is the next one, ticker ZS. Now this is also going to be in that cybersecurity arena. Long secular tailwinds, secure digital transformation is accelerating and top of mind in C-suite. You know, key trends, cloud shift, mobility, Internet of Things, rising threats, legacy phase out, and so on. When you think about these companies, especially when you think of like CrowdStrike and Zscaler, and there's some other names, you think about those, they're going to be very mission critical. Datadog, probably more tier 2 mission critical, but people aren't going to necessarily go out and just cancel their Datadog subscription. They might not add more modules as easily, but if you're using, you know, cybersecurity products, you're going to need those whether we're in a recession or not. And it's not that it can impact the companies, but I think that they have a little bit more insulation than some other companies. Another thing that people don't talk about enough, I don't think, is the fact that if you do a contract, again, I have a software as a service background, I used to sell this stuff. Contracts have built-in CPI inflation adjustment. That means that oftentimes it's actual inflation. So if inflation's 7%, your contract on that annual renewal is going to be 7% higher than it was last year. So they have an automatic pricing power built into their contracts, and I don't think people understand that. That does matter, okay? $72 billion serviceable market opportunity. It's like a TAM, but serviceable. Pioneer and leader in cloud security, was founded in 2007. It's been around for a long time. I'm not going to go into too much detail, but these guys are really big. They're growing. There are some risks like with any stock, but definitely check out Zscaler, ticker ZS. Okay, before I cover this last pick, this 10th pick, I did this as fast as I could. Definitely subscribe to the channel if these type of stocks interest you, because we have lots more videos on these exact stocks in much more detail, sometimes 20, 30 minutes. You can get all kinds of great due diligence. We make these videos on Fired Up Wealth to teach you how to be a better investor and to give you stock ideas. We're not here to be your financial advisor, tell you what to buy or sell or anything like that. We're just giving you some information. You do with that with you'd like and make your own decisions. But this last one, guys, I have to include it. Remember, we're focused on technology. A lot of what I'm focused on is still going to be in that cloud, as well as, you know, Tesla with EVs, but AMD, and they acquired a company called Xilinx. That's going to give them a lot more exposure into data center, and that's doing very well. So they're very similar companies. You think of NVIDIA and AMD, and they compete. Both of them, I think they have plenty of room, total addressable market to go after. There's plenty of fish in the sea to go catch. You know, these guys have lots of great things, data center leadership now, software enablement, and of course they're going to be down too with gaming, but they didn't actually fare as bad as NVIDIA, and they also aren't as expensive. The stock price is not nearly as expensive as NVIDIA when you look at the PE ratio, but both NVIDIA and AMD have a PE ratio. They're profitable. They're buying back shares. I think they're great long-term investments that are going through a tough cycle. Remember, semiconductors are cyclical, but there's still a huge mega trend behind it if you're a long-term investor. Hope this video was helpful, guys. Appreciate your time and attention. Have a great rest of your day. Take care.